Hey guys, we are here with Tom from Dragonfly Capital, and he'll be talking about decentralized exchanges. I will let him take it from here.
Thanks. Hi, everyone. I'm Tom Schmidt. I work at Dragonfly Capital. And before that, I led product at 0x. And then I was working on product at Instagram and Facebook. Today, I'm actually not going to be talking about aggregation theory. Instead, I'm going to be talking about decentralized exchange. But a lot of aggregation theory sort of works in here. And we're going to be talking through how decentralized exchange has evolved over time and sort of what the current state of the ecosystem is and how we think it's going to evolve over time. Without further ado, this is a brief history of decentralized exchange. I think, if you want to sort of zoom out a little bit, I think first we have to think of, why do we want decentralized exchange? Why do we use these sort of clunky tools that are just going through decentralized exchange? What does decentralized even mean? Talking through sort of some of the early primitive decentralized exchanges and what people used. Walk through sort of the current state of the ecosystem and the current companies that are doing decentralized exchange, and then looking forward and sort of projecting out and thinking about what might happen in decentralized exchange in the coming years. So, why are we here? This is Mark Karpeles from Mt. Gox, if people are familiar with him or with the Mt. Gox story. But this is the first centralized exchange hack and sort of kicked off a number of centralized exchange hacks where these single companies, these single entities that were custodying everyone's funds were hacked and hundreds of millions of crypto assets were stolen. So centralized exchange hacks are rampant. They continue to happen, and there's not really any clear path forward to necessarily stopping these all from happening. And so the one true way to stop centralized exchange hacks from happening is through self-custody. Another sort of reason why someone might want to use a decentralized exchange instead of centralized exchange is quite frankly just the lack of KYC. So you can serve all customers and all assets, and you're no longer geo-gated to a particular locale. You have to pass particular requirements, and this is really useful if you're in a country where maybe you don't have a centralized exchange that's serving you, and you can't get access to some of the larger centralized exchange. I think this is becoming more important as we see the centralized exchange ecosystem start to self-regulate. And buy insurance policies or work with trusted qualified custodians to make sure that users' funds are insured. I think the emerging trend also in sort of the decentralized exchange space is what we call programmatic access to liquidity, or money Legos or money connects. Basically, with one single transaction, I can use the decentralized exchange basically as an API to do swaps between any different assets that I want in one single transaction. So I can take out a loan on Compound, swap the asset that I borrowed on a decentralized exchange, and then go send that the asset that I swapped to a friend or to go do something else with it. And this sort of single atomic transaction, this composability, is something that just isn't possible with a centralized exchange because you can't rely on IOUs. You need sort of the full transaction to complete and for the asset to actually settle and actually be there. So it's a really unique property of decentralized exchange and something that is just really untouchable by centralized exchanges. And I think this last point is also becoming more and more relevant. I don't know if you guys have checked out any of the stuff that's going on with Unisocks or with Zora, but getting access to these long tail and ephemeral markets where things like NFTs or item drops, maybe even something like the UMA token sale. These are things that it might not make sense to go through the listing process on a centralized exchange for, or it might not even be possible to do, but that you still need an exchange to actually swap these assets. And so with a decentralized exchange, you have zero marginal cost, right? It's free to spin up an exchange. And we've seen that historically when we've broken down marginal cost to zero, that sort of allows entrepreneurs to come in and innovate and take advantage of all the new opportunities and this new lower barrier to entry. So what does decentralized even mean? This is kind of a touchy subject, but a lot of different components of a decentralized exchange can be decentralized. The custody can be decentralized, the listing, the liquidity, trade execution. They can all be sort of controlled or managed by a centralized party or maybe even a DAO, or be totally decentralized. But for the sake of this presentation, we're all going to be lumping everything under decentralized exchange, even though you could argue that something like Uniswap, which is totally trustless, there's no sort of way to interfere with it, is maybe slightly more decentralized than take your favorite off-chain DEX of your choice. So out of this Mt. Gox hack, we got a couple different flavors of DEXs. This is sort of in the 2012 to 2013 wave. You have HTLCs, you have what I'm calling native DEXs, and you have what we're calling ring exchanges. So an HTLC is a hash time lock contract. Basically, it's a way to, given an agreement, trustlessly swap any two assets using these special types of contracts on chain. So the terms are still negotiated off chain. So you need to find a counterparty through some sort of, probably centralized service such as BISC or local Bitcoins. But the actual swap occurs in a peer-to-peer manner. So you're never sending your funds to somebody else. So you sort of get that minimum viable decentralized exchange. But it's a bit expensive. It's kind of slow. It's inflexible. But for the most part, it's pretty robust and tested. It's not infallible, though. I think even just 2 weeks ago, we saw there was a BISC hack where basically this sort of centralized component of BISC itself was hacked, and basically people were tricked into performing a trade that was just impossible to actually execute. So again, users get to hold on to their funds. They get to self-custody. But you still have to find, you still need a separate party in order to actually find your counterparty for the trade. The next sort of flavor of exchanges are what we're calling ring exchanges. Ring exchanges kind of get lumped into decentralized exchanges, but they're not really decentralized when you think about it. What you're doing is you're sending your funds into a controlled address that a centralized party controls, and you're waiting for a counterparty to come by and trade. So Shapeshift, for example, I might send my Ether into Shapeshift, wait for someone else who wants to trade their Bitcoin for Ether, and then Shapeshift actually temporarily takes control of our assets and swaps them for us. So it's not really decentralized, it's not really trustless, but previously people thought that you sort of avoided custody, and therefore it's not an exchange. But I think we've seen that you actually do take custody, and therefore these things do look like a lot like exchanges. And as a result, we've seen most ring exchanges add KYC and other types of regulatory compliance measures. And there have been a few hacks with these ring exchanges as well. So in some respects, you kind of get the worst of both worlds, where it's not really decentralized, and you don't really get the performance or all of the features of a centralized exchange. And so the last bucket of early decentralized exchange is what I'm referring to as a native decentralized exchange. So part of the problem with blockchains is that they're really slow. You're waiting, several seconds or sometimes several minutes for trades to actually execute. And so what native decentralized exchanges discovered is you can make a custom-tailored blockchain that is really just designed to do decentralized exchange. So you have the Waves blockchain that is really fast. It's really smooth. It uses DPoS, so it's really high TPS, but it's only really used for swapping assets back and forth. So these things sort of work as advertised, right? They're relatively fast. They allow you to swap assets back and forth. But the problem is there aren't just that many assets on these blockchains that people want to trade, right? What good is a Waves blockchain, a Waves decentralized exchange, if the only thing I can trade are Waves tokens instead of Ether or Bitcoin or some other larger asset that maybe people want to trade more of? And so what these blockchains did is they basically built their own synthetic assets. In some ways, it's kind of like the predecessor to MakerDAO, where collateral was locked up and they used an oracle or a price feed to basically mint synthetic versions of assets that people actually want to trade. So if I want to trade US dollars, I can mint sort of a Waves US dollars or a BitShares US dollars that sort of functions the way DAI does today, but it exists on the Waves blockchain or the BitShares blockchain. And obviously, that's sort of the way you want to bootstrap liquidity is you're building up this volume. But I think what we've seen is these things actually weren't very well built. So this is the price of BitUSD, which is sort of the DAI equivalent, the MakerDAO equivalent on the BitShares blockchain, where it's a synthetic US dollar backed by the BitShares token. But due to a number of different bugs, it basically was never able to keep this peg, and it still trades well below $1 today. So these things had the right idea of what if we had this thing be sort of its own blockchain and we created synthetic assets. But the problem being that some of these implementations were just not the best. And I think what we've seen is we have more clever ways of getting the throughput that we want from a decentralized exchange without literally putting everything on a blockchain all the time. So we don't need a true tailored blockchain for decentralized exchange now. So out of sort of this early wave of decentralized exchanges, we got we still have people doing HTLC stuff. So this is things like Suma or SparkSwap or Arwen. basically doing atomic swaps across different blockchains. And this works really well for some particular implementations. It's still popular, like I mentioned, BISC is still being used. But out of the native wave of DEXs, we got sort of two different flavors of decentralized exchanges. One being what I'm referring to as on-chain decentralized exchanges, and the other being off-chain decentralized exchanges. So the first real on-chain decentralized exchange on Ethereum was Oasis, and the first off-chain is EtherDelta. So instead of having a custom-tailored blockchain for exchange, now we're using Ethereum, sort of this general-purpose blockchain, and adding decentralized exchange on top of it. So Oasis DEX was the first completely on-chain order book built by Maker to ensure that there's liquidity for DAI and MKR. If you think about it, the MakerDAO system really needs a decentralized exchange and you need liquidity for DAI and MKR for this thing to function. And when Maker was being built, there wasn't really such a thing. 0x sort of came out around the same time, but there wasn't really this sort of true on-chain, always-on order book to make sure that the Maker system could actually function as intended. So the Maker team built Oasis to sort of support the Maker system. So in early 2019, they transitioned it to ETH to DAI, but those old contracts are still live, so you can still trade MKR, still trade ETH, DAI, whatever on Oasis DEX. But the idea is, it sort of functions the way a normal exchange does, where market makers, submit orders on chain within a transaction, and the entire order book is basically stored on chain, so anyone can go see all the bids, see all the asks, and then choose to fill them. So it's truly censorship resistant. Anyone can get access to it because if you have access to the Ethereum blockchain, you have access to Oasis and the liquidity that's stored in the Oasis contracts. It's unfortunately, it's also costs a lot of gas because the market moves fairly quickly. So if at one moment Ether is 170, another moment it's 175. As a market maker, I have to go on chain, submit a bunch of transactions to cancel all my orders, and that becomes really inefficient. You start to eat through gas. So Oasis was one of the largest gas users for a while. And this is actually no longer true. I apologize. It was previously the largest Ethereum DEX by US dollar volume, which is sort of surprising because it's not something that people really think about frequently, but this was true even as of late last year. The flip side of this is, sort of trying to solve this problem that I mentioned at the end of the Oasis section, which is, if I'm a market maker, I want to provide great liquidity, which means great pricing and great spreads. But I can't do that if I have to submit Ethereum transactions all the time. It's really expensive. It's really slow. And so as a result, I can't really offer the best liquidity that I want. Whereas with a centralized exchange, it's instant to make an order or cancel an order. And so I can get really tight spreads. So EtherDelta pioneered this idea of off-chain relay, on-chain settlement. Basically, the order book is stored off-chain. So I can get that sort of free instant order creation, order cancellation, and only the order execution goes on-chain. So some server somewhere is holding on to all the order data. As a market maker, I can just ping the server and make orders, cancel orders, reprice orders, whatever. And then if a taker finds an order that they want to fill, only then do they submit an order into Ethereum to actually fill the order, and the EtherDelta smart contracts basically swap the assets on our behalf. So you still need this centralized order book operator, but it doesn't have there's no custody risk, right? The only thing they're storing is the orders, which is sort of its intent to trade. But you still hold on to your assets until the trade actually gets executed. Part of the problem with this, though, is that basically we've seen regulators not necessarily rule, but sort of lean in the direction that even if you're storing this off-chain order book, you look like an exchange. So you probably need to get a broker dealer. You might need to get an ATS license or KYC your customers, whatever, if you want to trade securities. So it really just looks like you're running a matching engine, but you just happen to not be taking custody. But that doesn't necessarily mean you're not an exchange. So the EtherDelta founder settled with the SEC about 2 years ago, actually, or a year and a half ago, because they were facilitating the trade of securities, they were allowing anyone to trade any sort of crypto asset that they wanted. So they had sort of this right idea of let's get better scalability, but the problem being that running this order book yourself is quite tricky. So where do we go from sort of the Oasis philosophy of on-chain to the EtherDelta philosophy of on-chain? The on-chain concept you can imagine again sort of splitting into AMM, or automated market makers, and order books or reserves that are also sort of on-chain still. And the off-chain world sort of split again into two, where you have some teams that went fully verticalized, so people like AirSwap or DDEX, and other teams that went into building a platform such as 0x. So AMM's really in vogue right now. In a nutshell, basically, this single contract on-chain holds all the liquidity and has this preset curve that tracks the ratio between the quote token and the base token. And the more you buy, the more expensive it gets, and the more you sell, the cheaper it gets. So this thing basically acts as this always-on market maker where anyone can come in and sell. Bancor actually popularized this concept, but in my opinion, it had a really poor token model, had a few hacks, and so we couldn't really get the traction, or it couldn't have lasting traction in sort of this later DEX world. Uniswap sort of took this same style, this same concept though, and built it open source, built it as a public good, fixed some of the token issues that Bancor had, and now is one of the top decentralized exchanges by volume. So again, you sort of this problem with off-chain order books where they're really efficient, but you still need a market maker to come in and post orders. You still need this central operator that's kind of run the server that holds the orders, which can be expensive and difficult to start. AMMs are really great because they allow anyone to start their own market and provide liquidity for it, which is sort of the missing thing from something like Ether Delta, for example. Downside being that you get really high slippage and they're not very capital efficient. So even just buying or selling a few $1,000s worth can move the price by several percentage points depending on the market. And there's other sort of attacks. People can sandwich your order, so you pay worse pricing. People can front run you. And then also market makers. This is sort of a complicated subject, but you can suffer from what's called impermanent loss, where basically your holdings in this contract get really out of whack. And so if you're someone who wants to provide liquidity into Uniswap, you may end up losing money, but it's not necessarily the case all the time. And in fact, it can be quite profitable. This is sort of an ongoing area of research, I would say, but can be an issue with some markets on some automated market makers. And interestingly, the AMM market is now sort of splitting and into what I would say is vertically tailored AMMs. So you have some teams that are going what I would call n-dimensional or multi-dimensional, so teams like Balancer, and you have teams that are going just fully vertically optimized, such as Curve or Cowrie. So you can think of this sort of like if anyone here's into sneakers or something like that, but sort of like what StockX is doing to eBay, where eBay is a really great generalized peer-to-peer exchange for physical assets. StockX has sort of come in and built a vertically integrated peer-to-peer exchange that's only good for shoes. So you go there, you're going to have the best shoe experience. The same way if you go to Curve, you're going to have the best stablecoin experience, whereas Uniswap is sort of more this generalized AMM. And so you have really specific features that are tailored to the specific vertical they're trying to serve, such as a basket of tokens for Balancer or stablecoins for Curve, and they're going to outperform Uniswap along some dimensions for the particular vertical that they serve. But in theory, if everyone sort of chooses their own market, you can sort of eat up this generalized approach to creating AMMs. So that's sort of the ongoing discussion that we're seeing in the DeFi community is which of these AMMs make sense for which particular markets. On-chain reserves, sort of similar to Oasis, but in a more generalized approach. So no longer just needing orders, you can sort of wrap other on-chain liquidity sources such as Uniswap. And in fact, Kyber now does about 10% of all Oasis volume and all Uniswap volume, where I send an order into Kyber. Kyber determines that Oasis actually has the best liquidity for me and will do the swap on my behalf. So it's in some ways sort of a little bit of an aggregator, where we're going to get into that a little bit later in the presentation. So you have this always on contract level liquidity, but again, still has the issue of needing to go on chain all the time to update the pricing so that market makers don't get hurt by price movements. And sort of this last component is off-chain relay, on-chain settlement. A lot of different permutations to what this actually looks like. Sometimes there's open order book, quote providing. We'd have to get into all the nitty-gritty, but you basically have this platform and allowing anyone anywhere in the world to build their own exchange on top of it, just using sort of a common settlement layer. You still have this sort of centralization risk, and you still need market makers to provide liquidity. But in theory, it's a lot more performant than having to go on chain all the time. And again, here you sort of see the different types of approaches. You have something like 0x, which is a protocol that relies on apps such as Token Law to build on top of it. Or you have teams that go fully verticalized and build a specially tailored product for their particular customers, such as AirSwap or DDEX, So similar concept in the off-chain relay, on-chain settlement, but really they sort of own both the app and the settlement layer. So that's all the different types of decentralized exchanges today. Where we go from here, I think the trend is pretty obvious nowadays, but it's really towards aggregation. So if you sort of look back to the traditional internet, we can see that this is a really popular concept in the way we think about sort of the FAANGs, the Facebook, Amazon, Netflix, Google of the internet industry today. These particular companies are what we call aggregators. So they aggregate all the demand. Everyone goes to Facebook, everyone goes to Amazon, and they then route to all the different suppliers. So when you buy through Amazon, you're going to be buying through thousands of different smaller suppliers who are actually selling through the platform or selling through the marketplace. So you can think of this as like Expedia for flights, Amazon for suppliers, Facebook for news, etc. In return, you sort of commoditize out the suppliers. So if you're using Amazon, you don't really care who's actually selling to you because Amazon is doing the routing and Amazon is sort of the interface that you think about. And so as a result, these suppliers get their margins compressed massively because now they're just pure commodities. And in a true commodity sense, you really lose a lot of your margin because there's no way to be more advantageous than another supplier other than competing on price. So in these kind of scenarios, you really want to be above the API. You want to own the demand. You want to be the aggregator. You don't want to be below the API. And you don't want to be away from the user and only being able to compete on price. So when you think about this in the context of decentralized exchange, decentralized exchanges really become liquidity suppliers where they can really only compete on pricing. So they can really only offer the best tokens at the best rates. And then these aggregators are the ones who own the demand. And they're the ones who are sort of the Amazon of DeFi, where users come to them. They're the ones who are routing the orders and making sure users get the best price. So this chart on the right shows 1inch's market share over the past 6 months. And you can see they now do, about a couple of weeks ago, about 12% of all DEX volume. So just think about that. All the DEXs that exist, 0x, Kyber, Uniswap, Oasis, 12% of all that volume is being filled through 1inch. So we expect this trend to continue, and it makes sense, right? It's a great user experience. You get strictly better pricing than going through any decentralized exchange. The same way when I go through Amazon, and I'm going to get way better pricing than going through any individual supplier or going through any individual airline. So this is sort of the natural way that industries that have zero marginal cost form is you have these individual aggregators who sort of commoditize out everyone who's supplying stuff to them. So here's you're sort of competing to provide the best liquidity. So onwards, layer 2 sort of breaks a lot of the atomicity stuff that we talked about earlier, and you have all these DEXs that are being filled through contracts, and DEX volume has been growing a lot, which is great, but still sort of lags behind decentralized exchange. So we really need to focus on some of the unique value props of DEX. But I'm going to sort of break the fourth wall here a little bit and say all this is to a certain extent irrelevant. When you zoom out a little bit, spot DEXs are really a very small game. They're really sort of this tiny little world in this bigger world of margin trading. So you have people like DYDX, Compound, Maker, that when you look at their volumes, here's another sort of take if you want to think about it. You have you're sort of bursting out of the matrix and really looking at the bigger game and thinking about the bigger game that you want to play. DYDX, which is a decentralized margin trading platform, some days does more volume than every single decentralized exchange combined. So they do more volume than Uniswap plus Kyber plus Oasis plus 0x. They do more volume than all of them combined. And so you sort of have this function where even if you're the best decentralized spot exchange, it's a smaller game, it's a smaller market to be playing than trading on margin. And that's sort of what we see in centralized exchange world as well, where centralized exchange margin volume is much higher than spot volume. It makes sense, right? Because there's just more capital flowing around. But this is kind of the trend that we've been seeing over the past few years, that we have people like Compound, people like Maker, people opening up loans and recursively borrowing them and then swapping on a decentralized exchange, or swapping on DYDX, for example. And that's really where the bulk of the volume is going, which makes a lot of sense when you think about this is just a better way to express people's price opinions, which is what these things are supposed to be for. And then if you want to zoom out even more, margin trading is really just sort of a small game, a small box in this bigger context of derivatives. So, on the right here, we see on the smaller chart being the total market cap of all global stocks. So you have US, China, Europe, all the countries, all the stocks, that's sort of the total market cap. And the right side, you have the global derivatives market size. Obviously these things are highly leveraged, and so therefore you're going to get higher notional volume. But the decentralized exchange world, we see futures volumes are 20 times higher than spot. So if you can really own this market, which is substantially larger, that's a much more interesting play. It's just a strictly higher ceiling than you'll be able to get with spot. So it's a more expressive, more capital efficient way to express opinions. And this is just sort of coming to market, right? We saw FutureSwap launch about 2 weeks ago with their alpha. DYDX announced that they're working on perpetuals. DerivadeX is also working on perpetuals, or a perpetual futures product. All these platforms are launching this year. Open, which is also, it's an options platform, but you can think of it sort of in the same light, in that it's a derivative which allows really leveraged ways to express your own financial opinions. Is already doing $2 million in notional volume. So when you get into these more complex instruments, when you get into these instruments that allow you to express your opinions in more aggressive or more complicated ways, these are kind of the things that go into to dominate the market, even more so than spot. So looking forward, I expect to see more and more of derivatives really dominate the decentralized exchange market, more so than the spot volumes that we've been seeing today. And this is already happening, as I sort of mentioned with the DYDX stat. So that is sort of decentralized exchange in a nutshell. Happy to take any questions that you guys have, or sort of go into any detail on anything that I talked about. Frank asked, who do you consider to be the FAANG of DeFi? Also, should one be more confident that each protocol has been audited, formal verification, etc.? I would say on the last part, do your own research. I think most of these things are pretty aggressively audited these days, and certainly more so than they were 2 years ago. And things like Uniswap, for example, do get formally verified now. I think you can also think about purchasing insurance, for example. So if you're lending out on Open, or lending out on Compound, you can insure your C tokens by buying options against them on Open. So it's another sort of way you can safeguard yourself. But I think for the most part, these things are pretty battle tested. So generally speaking, the longer something exists in existence without having been hacked in some way, the more safe it's likely to be. But I would say in terms of the FAANG, I would say we're still trying to figure it out, to be honest. I think as I sort of pointed out, we may be sort of the 2000s .com days, where it doesn't matter if you're Friendster, it doesn't matter if you're MySpace. Someone bigger might come along and just totally dominate the scene. And so it really matters what market you're trying to fight in. And I think the other important thing that I mentioned around aggregation and sort of being able to commoditize out your complements is also really important. And I don't really think we've seen anyone do that truly effectively yet. I think some of the DeFi, the aggregators, the lending aggregators, the DEX aggregators are well poised to make that kind of play. But I think it's still sort of early days, so TBD. What do you think will be the impact of flash loans? Another great question. Haseeb Qureshi, who also is at Dragonfly with me, wrote a really good blog post about a month ago on flash loans and their application. And I agree with him for the most part, which is basically flash loans just sort of accelerate the existing timeline, which is all these vulnerabilities were always vulnerabilities, right? It's not like these protocols have become any less safe because of flash loans. It's just that now people can actually exploit the exploits because they have the capital required. So I think historically there's been a bit of safety through obfuscation, where because the hackers didn't have all the capital necessary to do the exploit wasn't exploited. But now anyone can get any sort of capital that they want, and so there's really no more hiding. You really have to have really bulletproof code, otherwise you're just going to get owned. There's no more sort of way to mitigate that.
Awesome. Well, this was fantastic. I think we're out of time now and need to transition to the next session.
Cool. Well, thanks for attending, everyone. Hope you liked it. And you can catch me on Twitter at Tom H. Schmidt.
Awesome. Thanks so much.
Thanks. See ya.
Yep. Bye.